I am here to present or recap the preliminary topics, in particular, the transfer taxes. First, I would like to share the outline of my presentation. So, transfer taxes: A, state tax; 1, general principles; 2, determination of state tax; 3, gross state; 4, deductions; 5, exceptions. Letter B, donor's tax. 1, general principles; 2, determination of donor's tax; 3, we have exemptions; and C, states and trust. All right, so in this slide, as you can see, this is the diagram for the national internal revenue taxes, also known as the uh, national taxes, as different from the local taxes. So this actually is a bird's eye view of the national taxes. We have here the income taxes, transfer taxes, and business taxes. But the focus of my presentation is all about transfer taxes, the gratuitous transfer, mortis causa, and donation or gifts. Because the other topic under the prelim, which is the business taxes, uh, is reported or presented by other reporters. All right. So as we learned in our taxation one, under the income taxes, we have the tabular or individual. Then we have corporate, passive income. We have the capital gain tax. And transfer taxes, we have gratuitous transfer, the mortis causa or donation. Then under the onerous transfer, we have the value added tax, the percentage tax, and the excise tax. And it is under the business taxes. All of these taxes um, are subject, or they will require to have a documentary stamp. You know? Documentary stamp is actually also a tax, no? For the documents or any paper or any documents that uh, you're going to request, no, from the government. So especially this different taxes, no, any paper or documents must have a documentary stamp tax also. Next, we have the transfer. So under this diagram, so we have gratuitous transfer and onerous transfer. As what I have said, the focus of my presentation is all about the gratuitous transfer. So as we know that this transfer of goods or properties are for free. You know? Unlike the onerous transfer, transfer of goods or properties for consideration or price. So the main difference of the two is that in gratuitous transfer, there is no consideration or price. So under the gratuitous transfer, we have the mortis causa. So meaning at the time of death, then we have gifts, you know, or donation. You know. So we have donor's tax, and for mortis causa, we have the state tax. So these two are called transfer taxes, transfer gratuitously or without considerations. So again, the focus of my presentation is only here for gratuitous transfer. The onerous transfer will be discussed by the other reporter. Moving forward, so in order to understand well about the transfer taxes, it is best that we should define what are transfer taxes. So accordingly, transfer taxes are those taxes imposed upon the privilege granted by the state to the taxpayer so that he may transfer properties, real or personal, without consideration. So if without consideration, actually that is a gratuitous transfer. Next, what is the nature of transfer taxes? So it is said that transfer taxes are excise or privilege taxes that are imposed on the act of passing ownership of property and not taxes on the property transfer. So actually there are two kinds of definition of the excise tax. The other one is the luxurious or sin taxes. But in this context, we define excise or tax as a privilege or right to transfer. So the other definition is for excise tax as uh, a luxurious or sinful tax. Or but in this context, we define excise tax as a privilege tax or of the right to transfer properties. Right. So first topic, we have the estate tax. So under the uh, uh, transfer taxes, we have estate tax. So what is estate tax? Estate tax is the tax on the right to transmit property at death on an uncertain transfer by the decedent during his lifetime, which are made by the law equivalent of testamentary disposition. So that was stipulated, or that was extracted from the Book of English 2018. Also, the estate tax accrues upon the death of the decedent, meaning um, it will only legally enforceable or start upon or after the death of the said decedent. Likewise, a transmission by inheritance is taxable at the time of the predecessor's death, notwithstanding the postponement of the actual possession or enjoyment of the state by the beneficiary. Uh, it is discussed in the case of Lorenzo versus Posadas in 1937. All right, moving forward. Um, fast forward. So, state tax is levied upon the transfer of the net estate under Section 84 of the tax code. So again, state tax accrues at the time of the decedent's death, distinct from obligation to pay the same as X by law. Also, the tax is measured by the value of the property at the time of death. So subsequent appreciation or depreciation is immaterial. And lastly, state taxation is governed by the statute in force at the time of the death of the decedent. And tax laws cannot be given retroactive effect unless they explicitly provided for it. So that was in Section 3 of the Revenue Regulations 12-2018. Next, so what is the rates of the state tax? So under Section 84 of the tax code, there shall be levied, assessed, collected, and paid upon the transfer of the net state as determined in accordance with Section 85 and 86 of decedent, whether resident or non-resident of the Philippines. And accordingly, a tax rate at the rate of 6% based on the value of such net state. So as amended by the train law, because the old one is the uh, graduated tax rate, no? And in the train law, we have a flat rate of 6%. Then please take note also that the train has removed the graduated rates for state tax, as I mentioned, no? Graduated rates. As it now stands, state tax has a flat rate of 6% based on the value of the net state of the decedent. To complement with that, with the Section 84 of the tax code, we have also the revenue regulations issued by the Bureau of Internal Revenue, RR 12-2008. So under Section 2, the rate of state tax, no? The state tax, the net state of every resident, whether resident or non-resident of the Philippines, as determined in accordance with NIRC, shall be subject to an state tax at the rate of 6%. So it is only a supplemental regulations or a complement of the rate of state tax under the National Internal Revenue Code. Moving forward, so under also in the same regulations, the legal basis for the imposition of state tax is under the Section 3 of the Revenue Regulations of the said Revenue Regulations 12-2018. So I will allow me to read. It is a well-settled rule that state taxation is governed by the state statute enforced at the time of death of the decedent. So the state tax accrues as the death of the decedent, and the accrual of the tax is distinct from the obligation to pay the same. So upon the death of the decedent, succession takes place, and the right of the state to tax the privilege to transmit the state is instantly upon death. All right, so it is only enforceable after the death of the decedent. And accordingly, the tax rates and procedures prescribed under these regulations shall govern the state of decedent who died or after the effectivity date of the train law. So therefore, if the decedent died, no, on or the effectivity of the said train law, so the 6% rate of the tax, no, from the net state of decedent will be applied. Okay. Now let's proceed to the determination of the value of the state. So under Section 88 of the tax code, which is the valuation of the gross state. So as a rule, gross state is equal to the fair market value at the time of the decedent's death. So that was under Section 5 of the Revenue Regulation 12-2018. So it's a general rule that the fair market value of the gross estate shall be followed, no, at the time of the decedent's death. So with regard to the real property, so number one, the appraised value, whichever is higher between A, the fair market value as determined by the Commissioner of Internal Revenue, or the also known as the zonal value, or B, fair market value as shown in the schedule of values fixed by the provincial or city assessor's office. So whichever is higher would be the the gross state or the value of the state of the decedent in valuation of the state. Next is number 2. If there is an improvement, the value of improvement is the construction cost per building permit or the fair market value per latest tax declaration. So if there's an improvement, so whichever is higher pa rin, so it's either the improvement of the construction cost per building permit or the fair market value per latest tax declaration. So as stipulated in section 5 of the RR 12-2018. Meanwhile, with regard to the personal property, so to evaluate the estate of the decedent, one, we have the fair market value at the time of death. So as if you have remember, no, if you have as I have mentioned, no, that the general rule as a rule, so at the time the fair market value at the time of death of the decedent. No? If it is a shares of stocks, if it is listed, the fair market value is the mean or the average between the highest and the lowest quotation at a date nearest the date of the death, no? Of death of the decedent if none is available on the death of death. So if there is no fair market value, there's no available, so it would be the average or the mean between the highest and the lowest quotation. If it is unlisted naman, so the book value at the time of death for the common shares or par value for the preferred shares. So, as stipulated again in section 5 of the RR 12-28. Right, so moving forward. Okay, now let's proceed to the gross state. So under the gross state, so vis-a-vis with the need state of the decedent, so what is gross state, by the way? So the gross state is the value at the time of the death of all the decedent's property, whether it is real or personal, tangible or intangible, wherever it is situated. However, in the case of an NRA, NRA means non-resident alien at the time of his death, only that part of the entire gross estate which is situated in the Philippines shall be included in his taxable estate. So under the section 85 of NIRC. Therefore, if it is a non-resident alien, if his or her property is not located or cannot be found in the Philippines, it is excluded from the taxable estate. Next is the net estate. So what is net estate? It is defined as the value of the gross estate minus or less allowable deductions. So later we will discuss what are those allowable deductions. So it is also called a net taxable state, no? After deducting the net share of surviving spouse, if any. So again, the tax rate is a flat rate of 6% under section 84 of the tax code. Okay, to continue, we have also here the composition of gross estate. So what are those composition or coverage for the gross estate? So the items to be included in the gross estate under section 85 of the tax code, we have number 1, the decedent's interest. This includes property owned by the decedent actually and physically present in his estate at the time of his death. Second, we have the properties not physically in the state, such as A. Transfer and contemplation of debt. B. Revocable transfer. C. Property passing under general power of appointment. So also we have the proceeds of life insurance, then prior interest, and the transfer for insufficient considerations. So those are the items, no, to be included in the gross estate of the decedent under Section 85 of the NIRC. Okay, so now let's proceed with the deductions. No? So deductions are to be deducted, of course, from the gross estate in order to get the net estate of the decedent. So under Section 86 of the tax code, no, as amended by the Train Law, no, or Republic Act number 10963. Please take note that the Train has made the following changes in computing the net estate of a citizen or resident of the Philippines. So it no longer allows the following deductions. So previously, the funeral expenses, the judicial expenses, and the medical expenses was included in the old tax code, no, as the deduction. But with the advent of the Train Law, all of these three were already or no longer allows for the deduction from the gross estate. So also, please take note that it has increased the following deduction. So from standard deduction to 5 million, no? If I'm not mistaken, from 1 million to 5 million standard deduction, and for family home from 1 million to 10 million deductions. So under the new or the Train Law, right? So moving forward, so hence the deduction from the gross estate are now one. We have the standard deduction. This is already in the Train Law. The deduction from the gross estates which are allowable. We have the standard deduction, the claims against the state, claims against insolvent persons, unpaid mortgages, accrued taxes and losses, vanishing deductions, transfer for public use, family home, and amount received by heirs under Republic Act number 4970. Right? Moving forward, so in the next slide, you can see the computation of the net estate from the Section 86 of the tax code, no, as amended by RA number 10963, also known as the Train Law. Accordingly, for the purpose of the tax imposed in this chapter, the value of the net estate shall be determined A, by deduction allowed to the estate of a citizen or resident. In the case of citizen or resident of the Philippines, by deducting from the value of the gross estate, no? We have the standard deduction, an amount of equivalent to 5 million pesos. No? It was increased to 5 million from 1 million in the old tax code. So please take note that you should not forget to deduct 5 million every time you compute for the net estate. No? You do not need any substantiation either. Okay. So if you're going to compute for the net estate, so do not forget, no, or to deduct 5 million. Okay. So the formula for computation of the net state is gross state minus or deduct the allowable deductions, so resulted to a net state. Then you will multiply that net state to 6%, no, flat rate, no, 6%. Then whatever the result of that, so that is the taxable due for the net state of the decedent. All right, to continue, moving forward. So we have here the exemptions rather, from state tax. So under section 87 of the tax code. So accordingly, these are the following, no? Are exempt from the state tax. Number one, merger of usufruct in the owner of the naked title. Second, transmission or delivery of the inheritance uh, or legacy by the fiduciary heir or legality to the payee commissary. And the third one is the transmission from the first heir, legatee or donee in favor of the another beneficiary in accordance with the desire of the predecessor. So those are the exemptions from the estate tax. Then we have also another exemption, the number 4 exemption, all bequests, no, devices, legacies, or transfers to social welfare, cultural and charitable institutions, no part of net income of which inures to the benefit of any individual, provided, however, that not more than 30%, no, take note, 30% of the said bequest, devices, legacies, or transfer shall be used by such institution for administration purposes. Then the fifth one, or number 5, the irrevocable life insurance to someone other than the state administrator or executor. The number 6, we have GSIS or SSS benefits. Then 7, we have the retirement benefits for private firms approved by the BIR. And lastly, the number 8, the separate property of the surviving spouse. So those are the exemptions from the state tax, no, under section 87 of the NIRC. Right? Next slides. So that was the first topic. Is all about the state tax, no, of the decedent under the gratuitous transfers. Now, let's proceed to the donor's tax. So another gratuitous transfer is the donor's tax. All right. In order to understand well about what's the donor's tax all about, first let us define what is donation. So donation, accordingly, under Article 725 of the Civil Code or New Civil Code, it is an act of liberality whereby a person or donor, no, it's an act of liberality means a generosity from the donor disposes gratuitously of a thing or right in favor of another, which is the donee who accepts it. So again, donation is one of the gratuitous transfer because it has no consideration or price, no, meaning it's a free disposition of property. So Next, what is donor's tax? So it is said that it is a tax uh, on donation or gift and is imposed on the gratuitous transfer of property between two or more persons who are living at the time of the transfer. It shall uh, apply whether the uh, transfer is in trust or otherwise, whether the gift is direct or indirect, and whether the property is real or personal or tangible or intangible. All right. So next, so in order to have a completed donation, no, uh, we have four essential elements. No? The acronym is ADIC. So, the elements for the our essential elements for donations are one, we have capacity of the donor. Of course, under the new civil code, the donor must have a legal capacity to donate, and the he has also a donative intent. No? The donor has a donative intent. Then we have a delivery of the gift. No? The gift must be delivered to the donor. And of course, the last element is the acceptance of the donor. So in order to have a completed donation, no, these four elements must be present in order to have a completed transfer of the property to a gratuitous transfer through a gratuitous transfer of donation or uh, the inter vivos, no? Donation inter vivos rather. Okay. All right. So let's proceed. Moving forward. So again, there are two kinds of donation. We have here the mortis causa, mortis causa, and also we have the inter vivos. Okay. So if it is a mortis causa, so meaning upon death or after death, no, it is subject to estate tax. Then donor retains ownership before his death. No? Then transfer is void if the donee dies ahead of the donor. And we have also the donation inter vivos, which is subject to donor's tax. No? Then it will take effect during the lifetime of the donor. That is called inter or within life. That is called the uh, donation inter vivos. Okay, so those are gratuitous transfer, no? Donation. Right. Next, under Section 99, the rates of the tax payable by the donor. So, and letter A, the tax for each calendar year shall be 6% computed on the basis of the total gifts in excess of 250,000 pesos, exempt gift made during the calendar year. So, as I have mentioned earlier, so under the just like in the state tax, no, the donor's tax is has also a flat rate of 6%. No? Unlike before, so as you can see in the left side, no, in the left side illustration or picture, no, this is the old graduated tax rates of donation. No? So with the advent of the trade law, so it is now the donor's tax is now has a flat tax rate of 6% on net donations for gifts, no, exceeding 250,000, regardless of relationship between donor and donee. Because before, so you need to identify if the donor is relative, no? Because if the donor is a stranger, there was a 30% of the net gifts. So mas malaki yung tax rate, no? If the donor is a stranger, right? So, but in the present, we have the train law. So the donor's tax has now a flat tax rate of 6% after deducting the exempt gift of 250,000. All right, moving forward. So in terms of rates, no, the train law has made the following changes. No? So So it has increased the threshold for exempt gifts during the calendar year to 250,000, no? From previously 100,000. Then the flat rate of 6% of total gifts and excess of 250,000. So, and also it removed the distinction. As I've mentioned a while ago, it removed the distinction between strangers and non-strangers. And please take note also that the 250,000 counts as a deduction from the total gaps because the 6% rate is imposed on the total gaps, no, in excess of 250,000. So the first 250,000 amount, no, from the donation is exempted from the, or 0%, no, exempted from the tax. No. Only in excess of 250,000 is taxable with a 6% flat rate. All right. So moving forward, so as you can see in this slide, so we have a sample computation in computing or getting the donor's tax. So based on the illustration, so there are three donations were made, no? From January 30, 2018, then March 30, 2018, then August 15, 2018. So how are you going to compute for the donor's tax, no? In the calendar year 2018? So first in January 30, 2018, there was a donation of 2 million. No? Again, based on the train law, the first 250,000 is an exempt gift. So you will deduct 250,000 from 2 million. So we have 1,750,000. All right. Then you will multiply it with 6%. Then the result is you have a donor's tax, no, of 105,000. So we have a tax due of 105,000 in January 30, 2018. So second donation on March 30, 2018. We have a 1 million donation. Then you will add the January 30, 2018 donation. So you will have 3 million less the exempt gift of 250,000. So it will have 2,750,000. So the tax due thereon is 165,000 minus or less the tax due paid on January 30, 2018 donation, which is 105,000. So the result, the difference now is 60,000, which is the tax due payable on the March 30, no, donation. And lastly, on the third donation, on August 15, 2018, we have 500,000. Then you will add the first donation from January and the second donation from March 2018. So less or minus the exempt gift, no, of 250K or 250,000. So the result is 3,250,000. So that's the tax due thereon on August 15, but you will deduct or minus tax due paid, no? Tapos mo nang nabayad from January and the second donation March. No? So 195,000 minus 165,000. So the tax due now for payable on the August donation is 30,000. All right. So this is an example of, actually this is only a review on the computation of a donor's tax based on 3 donations in a calendar year of 2018. Right? So to continue, so determination of the donor's tax. No? Under section 102 of the tax code, valuation of gifts made in property. Accordingly, if the gift is made in property, the fair market value thereof at the time of the gift shall be considered the amount of the gift. No? In case of real property, the provisions of section 88B no, shall apply to the valuation thereof. So the property comprising the gift or donation shall be valued based on their fair market value, as I mentioned earlier, as of the time of donation. So if the property is a real property, the fair market value thereof as of the time of the donation shall be. So whichever is higher, no? From the fair market value as determined by the commissioner and the fair market value as shown in the schedule of the values fixed by the provincial and city assessors. So whichever is higher. So that's the valuation of the donor's tax. Okay. All right. So moving forward, continue. So we have here a summary, of the valuation of gross gifts. If the donation is forecast, so the valuation is the face value, of course, because it is a cost. Then if it is a personal property, at fair market value, as I have mentioned earlier, at the time of gift is considered. Meanwhile, if it is a real property, the fair market value as determined by the commissioner and the fair market value as shown in the schedule of values fixed by the provincial and city assessors, of course, whichever is higher. So, yun yung valuation ng gross gifts. And meanwhile, if it is unlisted shares of tax, the common book value prepared or par value. Then with regard to the listed shares, so of course the fair market value. That's how the gross gifts was valuated. All right. So next topic is the exemptions. What are those exemptions of certain gifts? So under section 101 of the tax code, these are the following gifts or donations which are exempt from the tax provided in this chapter under the tax code. So A, in the case of gifts made by a resident, number 1, the dowries or gifts made on account of marriage and before its celebration or within 1 year thereafter by parents to each of their legitimate, recognized, natural, or adopted children to the extent of the first 10,000 pesos. So it is exempt, from the first 10,000 pesos. Then we have also number 2, the gifts made to or for the use of the national government or any entity created by any of its agencies, whichever is not conducted for profit, or to any political subdivision of the said government. And number 3, gifts in favor of an educational and or charitable, religious, cultural, or social welfare corporation, institution, accredited non-government organization, trust, or philanthropic organization, or research institution, or organization, provided, however, that not more than 30% of said gift shall be used by such donee for administration purposes. Please take note also that the entity must be, no, in order to qualify or to exempt from the gifts, no, donation. It must be a non-stock, no, non-stock corporation paying no dividends, no, then governed by trustees who receive no compensation, and uh, devoting all its income to the accomplishment of the purpose enumerated in its article of incorporation. All right, to continue, we have here the last topic, which is the states and trust tax, state and trust income tax. So before we proceed to the states and trust tax, let us first define state and trust. What is, as a review? So state is created by operation of law when an individual dies, leaving properties to heirs, mass of property, rights, and obligation left behind by the decedent upon his death. For purposes of income tax, the state may be under judicial administration or not. So trust is also defined as a review, legal arrangement of owner of the property as a trustor, transfer ownership to a person, which is the trustee, to hold and control the property for the benefit of another person, which is the beneficiary. So trust subject to income tax, just like also the income of the state, of the decedent, accumulated for the benefit of the unborn or an uncertain person, for the benefit also of the accumulated or what do you call this, for accumulated or held for the future distribution under the terms of the trust. C is to be distributed currently by the fiduciary to the beneficiaries. All right. So another distinction between the state and trust. So it is collected, trust is collected by the guardian of an infant, is held or distributed as the court may be direct, or income in the discretion of the fiduciary. However, in the gross income, no, income of state and trust, same as that of an individual taxpayer. So the computation of the, the estate and trust is the same with the computation in taxo and the same computation with the individual taxpayers. Okay. Moving forward, about the accounting period, so it is all the same. State and trust accounting period is calendar year, not fiscal year. So in terms of deductible expenses, no, in state, same to an individual taxpayer. However, I also in trust, same to an individual taxpayer, deductible expenses. However, and the state, the amount of the income of the state that is paid or credited to any legatee, heir, or beneficiary. So in trust, the amount of the income of the trust, which is to be distributed currently to the beneficiaries. And lastly, amount of the income collected by the guardian of an infant, which is to be held or distributed as the court may direct. All right. So that was the difference between the state and the trust. All right. So in this slides, as you can see, we have here the decedent, the state, and the heir. So these are the three entities, no, The decedent, of course, the person who um, or a dead person, no, who has a will or has a property which is called the estate. Uh, it is it is given to his or her heirs, no? And the estate is managed by executor or administrator. When you say executor, it is named in the will, no, holographic will or in testamentary will, while the administrator, the difference of executor and administrator is that the administrator is appointed by the court. Okay. So in the next illustration, we have this trustor, the trustee and beneficiary for the trust. So as we all know that the trustor is the person who established the trust, and then the trustee is the person who takes and holds the legal title to the property in trust for the benefit of another, which is the beneficiary. And lastly, the beneficiary is a person who has the equitable title or interest in the property and enjoys the benefit of the administration of the trust. Sorry, that was only a review with regard to the trust. We have already discussed that one in our partnership, agency, and trust subject in the third year. All right. So next slide. So in this matrix, so it will differentiate or distinguish between the income of the estate and trust and the estate tax. So under section 60 to 66, the actually this is a comparison between the estate and trust tax and the estate tax. So estate and trust tax, of course, it is the income of the state and trust, while the estate tax under section 84 to 97, it is the transfer, no? Gratuitous transfer of the estate of the decedent to the heirs. No? So the main difference that the estate and trust tax is the income of the state, and it is computed the same with the individual taxpayers, no? Or income tax of the individual taxpayer. However, in the state tax, it is computed with a flat rate of 6%, no? With the net state of the decedent. Okay, after deducting the allowable deduction from the gross state, so the net state multiplied by 6%, so that will give a result of the result is the taxable due for that particular estate tax. So that's basically the main difference between the estate and trust tax and the estate tax. So under section 60, so to emphasize the imposition of tax, so application of tax, the tax imposed by this title upon individual shall apply to the income of states. No? And again, take note, incomes of states. Like the estate tax, the tax for the estate of the decedent. So under the estate and trust tax, so the income of states or of any kind of property held in trust, no? Including income accumulated in trust for the benefit of unborn or uncertain person or persons with contingent interest, and income accumulated or held for future distribution under the terms of the will or trust. Second, income which is to be distributed currently by the fiduciary to the beneficiaries, and income collected by a guardian of an infant which is to be held or distributed as the court may direct. And third, income received by states of deceased persons during the period of administration or settlement of the state. And fourth, income which in the discretion of the fiduciary may be either distributed to the beneficiary or accumulated. So that was for the estate and trust tax. No? Again, I would like to reiterate that in section 60 to 66 is the income of the estate and trust. No? And it is computed the same as the individual income of the taxpayer. So how to get the income of the states? The same graduated tax, no, of the individual taxpayer. However, in estate tax under section 84, rate of estate tax, there shall be levied, assessed, collected, and paid upon the transfer of the net estate as determined in accordance with section 85 and 86 of every decedent, whether resident or non-resident of the Philippines. So a tax at the rate of 6%. Now again, ulit-ulit, 6% flat rate for the estate tax and also for the donor's tax. So the same lang sila. So the tax rate is 6% from the net state of the decedent based on the value of such. Okay. Under section 85, once again, the gross estate. So as compared to the estate and trust tax, estate and trust income, the gross estate, the value of the gross estate of the decedent shall be determined by including the value at the time of his death of all property, real or personal, tangible or intangible, wherever situated, provided however that in the case of non-resident decedent, who at the time of his death was not a citizen of the Philippines. Only that part of the entire gross estate which is situated in Philippines shall be included in his taxable estate. Okay? And lastly, the last slide is attenuation with the comparison between the estate and trust under section 60 to 66 and estate tax under section 84 to 97. So the taxable estate and trust are taxed in the same, as I mentioned a while ago, taxed in the same manner on the same basis as in the case of an individual. While in the estate tax, a tax at the rate of 6%, no? Based on the value of such. While in section 60 to 66, based on income derived from the estate or trust. Okay? Income from the estate or trust of a decedent. Yun yung kinukunan ng tax, no? State and trust income tax. Okay? And then in state tax, actually it is an excise tax, no? Again, once again, I would like to reiterate that excise tax in this context is the right to transfer the property, because there are two kinds of excise tax, definition rather of excise tax. The other one is the luxurious or sinful taxes. But in this context, the excise tax here is the right or privilege to transfer the property, imposed on act of passing or transferring the ownership of the property at the time of his death. Then the accrual open debt of the decedent, is decedent, sorry for the typo, decedent, and should be settled within 1 year from the death of the decedent. All right. So I think that would be all for the recap of the preliminary topics, no? In particular the transfer taxes or the gratuitous transfer, no? Because there are two kinds of transfer. We have gratuitous and the onerous. So as a review, gratuitous means it is pre-transfer, no? And onerous is a transfer with price or consideration. And onerous transfer are those also known as mga business taxes, no? Like the value added tax, the percentage tax, and the excise tax. And that would be discussed by the uh, other reporter, you know, after my recap on transfer taxes, in particular gratuitous transfer. The onerous transfer or the business tax, as I have mentioned, the value added tax, the percentage tax, and the excise tax will be discussed by the other reporter. So thank you very much for listening.